use of fixed income in a low-rate world. I'm Albert Buerta, and I've got a couple of ideas to share with you today. Welcome to the session. Please ask any questions that you may have. We will answer them in the chat. I will be first, and then I'll be joined by my colleague, Cornelio Kiwi, thereafter. I hope you've enjoyed the day thus far and that I can answer some questions as well. So, what's the problem with rates? This is our reality at the moment. Up on the screen, you'll see just a couple of different colors and lines, and it's a mix of what we've experienced in recent times, as well as what we are likely to experience over the next couple of months. So the gray line is the actual JIBAR rate for the last couple of weeks and months, and the blue line is the headline CPI. And what you'll see is for the first time in years, effectively, we've seen a persistent fall where we are going to see a negative real JIBAR rate. And this is likely to persist for the next couple of months. If you look at the FRA market, you'll see at the moment at least, there's not a very aggressive rate hiking cycle priced in by the SARB. And we only really start gaining meaningfully real JIBAR rates towards the end of 2022. Now, this is not a unique South African problem. We've seen this happen globally for the last couple of years. We've even seen this happen in South Africa, although not recently. So it is a problem that investors have not had to deal with, at least for the last 5 years. If we look at a decade of the returns on the Ashburton Stable Income Fund, we'll see that for most of the last 5 years, the real rate of return on this portfolio has actually been quite significant. It peaked out at about 4.5% above inflation at some point. But if you go back a little bit further to the 2012-2011 period, you'll see that the returns on these kind of portfolios was actually pretty much in line with inflation and expected inflation for a couple of years. Now, going forward, we expect that this type of portfolio is likely going to give you about 5.3 to 5.6%. So it's still about 1.2 to 1.4% above our expected inflation rates. The question that we're often faced with, however, is how do we deal with that in a world where bonds, the 5-year bond is giving you 7.2%, and the 10-year bond is giving you 9.2%. So effectively CPI plus 3 or CPI plus 5 respectively. Now, this is quite often how people in these positions look at the fixed income world. It's a question of, are we taking duration risk or are we taking credit risk? And every rand invested in bonds is a rand you can't invest in credit, and vice versa. So you'll see, effectively, that this is what a portfolio outcome looks like. You can either invest your complete amount in a bond that's giving you 9.5% initial yield and a 6.5% portfolio duration, and then your yield on the portfolio is about 9.5%. Or you can invest effectively everything in credit, duration of 0.125, and JIBAR plus 350 on the high end, and JIBAR plus effectively 1% at the low end. Or any combination in between, right? That's generally the way that people tend to look at this. So when we have this discussion with our clients, specifically about how fixed income and credit should be applied to portfolios, quite often we're in a position where if they have this view, they are at least over-prioritizing or over-allocating to bonds relative to credit, because even the most aggressive credit portfolio that we would sell would just get you to 7.3%, whereas a government bond could quite easily get you to 9.5% yields. The problem is that, at least in my perspective, that these things aren't light switches. They tend to work more like dials or levers that you can pull. And you can independently decide how much risk you want to take of each. So, if you look at this portfolio, where you do an overlay on top of a credit book of duration or bonds, it gives you a much better idea of what a portfolio outlook would look like. You independently decide what degree of credit risk you are comfortable with, whether it's highly liquid bank paper, JIBAR plus 100, high yield credit at JIBAR plus 350, or anything in between. And then separately from that, you decide, well, how much bond duration do I want? Do I want to stick my bond duration at 1? Then you effectively do a overlay trade or a structural trade on top of a credit book that gives you a duration of 1 or 2 or 3 or all the way to 6.5, where you effectively have both full exposure to the bond market and full exposure to the credit market. And as you can see, this gives you a range of options that gives you a much higher expected return, or expected return similar to what you would get in a mix of portfolios by taking a little bit less credit risk and a little bit less bond risk. This overlay strategy, by combining strategies at the same time, by combining both credit allocations and bond allocations in the same book, is effectively what we would call the false dichotomy of the choice between credit and duration. In practice, in many of our mandates, we don't have to choose. The same amount of assets is exposed to both credit risk and duration risk. Now, there are a number of ways you can do this, right? The first one, and the simple one, is just using an interest rate swap. Swap your fixed rate exposure to floating rate exposure. In the 1 year space, for example, the 1 year fixed rate is about 30 basis points higher than the JIBAR rate. You can do that out all the way to 5 years if you want. The problem that you have there is that while it's cheap, it tends to be less liquid. Unwinding swaps is sometimes a hassle. And actually, the expected returns on those numbers are lower than you'd get in some other spaces. The other thing that we use quite a lot in our bond funds and our multi-asset funds is we use the TRS. Now, a total return swap is relatively simple. I pay you JIBAR plus a spread, or the bank JIBAR plus a spread, and the bank pays me either ALBI or Govy or the iGovy or a basket of bonds that I determine, or an individual bond. Now, these terms vary anywhere from 3 months to 6 months or longer. They're slightly more expensive because you tend to pay JIBAR plus 30 to JIBAR plus 50, depending on what you're swapping. But you've got a 3-month swap or a 6-month swap rather than a 1 year swap. They also tend to be a little bit less customizable than some of the other options, primarily because you tend to easiest enter into these kind of TRS arrangements on an already established index, the ALBI being an example. The last option that you can do is you can adjust your book by using repos. Now, repos are used very widely, specifically within Ashburton in our LDI book. Chris Sirium, who's also a speaker today, is our resident expert there. It's cheaper to do than TRSs, quite often because TRSs include exposure to less liquid bonds, whereas in the repo market, you can pick the most liquid bonds. They're also more flexible. You're not tied down to an index, etc. Now, like we're all familiar with, there is no such thing as a free lunch. Right? These kind of structures generally have the downside that they tend to lower liquidity and increase complexity as part of solutions. Now, in practice, however, the low liquidity is not that much of a sacrifice, because as we know, credit in South African markets tend to be relatively less liquid than many other asset classes already. So if you already have a less liquid credit book, overlaying it with 3-month TRSs or 3-month repos don't significantly affect the overall liquidity of your solution. The potential complexity is an issue that I know some clients sometimes need to deal with, but either myself or Chris or anyone else of the teams generally have a lot of experience in dealing with that. The increased duration on these books does lead to high volatility, certainly, but this can and is managed quite often by using derivatives and option exposures in these kind of books. And then lastly, the increased credit that you have as part of the solution also lends its own unique issues to the South African market. And Cornelia will be up after me to talk about some of the ways we look at both the credit origination and research process that we can effectively reduce the credit risk within books. So just quickly, what are one of the ways that we can reduce, say, for example, the bond volatility and the bond risk within one of these structured solutions? Now, all we've done here is we've looked at the 1 year rolling returns of a 10-year bond, and then we've done a theoretical 1 year OTC option overlay on top of that to give me 2 series. The yellow series is what the returns would be without an option overlay, and the grey series is what the returns are with the option overlay. And effectively what you are doing is you are giving away some upside for some downside protection and, very importantly, some reduced volatility. The reduced volatility in this space, this option delta being somewhere in the order of 0.4 to 0.5, depending on how it's structured, means that the overall volatility of your bond position within, say, a multi-asset solution drops by 40 to 50%. So that's the one advantage. The other advantage is that the tails of your distribution become narrow. You can see there that most of the time, your expected return, or your return over a one-year period, on the yellow line is pretty similar to the grey line. Now, we know that's true because, for example, anywhere by approximately 90% of a bond's return over time is determined by the yield rather than by the capital gains. This is only different in extreme scenarios. And the longer a period becomes, the more a bond return is determined by yield rather than capital gain. The other important thing is that your expected return in this kind of circumstances remains pretty much unchanged. So by structuring a book in this manner, what you have is effectively a low volatility with tail risk hedging solution. Now, we use this in a lot of different portfolios. We use it in our multi-asset funds. We use it in some of our bond funds. But it's very useful in the solution context and ties in with a lot of the ways that we tend to look at bonds within a solution product, whether that is for the multi-asset low equity, multi-asset income funds, or any other type of customizable solution that we might put together. This is my last slide. I'm now going to hand over to Cornelio Kiwi, who will be talking to you about the ways we look at credit and the ways we mitigate origination and credit risk within our portfolios, both, once again, within a solution framework, but also from a one-off credit framework. Thank you very much for your time, and please enjoy the rest of the day.
Thanks, Albert. So, look, I think if we want to understand including credit in a portfolio in a current environment where we are seeing spreads tightening again, it's probably important to take a look back at what we've seen in the sort of 5 years leading up to those initial COVID-related lockdowns, and that's really showing on this slide. So from sort of 2017, even mid-2016, it was an environment of a lot of flows into low-risk cash and enhanced cash mandates, and we also saw an increasing participation by the banks in the sort of listed capital markets to invest into high quality liquid assets. And what that really did is create a supply-demand mismatch for that period. And you could see in this graph how spreads have tightened during this, during that time leading up to the COVID-related lockdowns. And just looking at the next slide, I think this sort of takes us to then March 2020. We've seen sort of this spread compression, and all of a sudden we had this sort of sudden stop economic event. We had these first hard lockdowns, and what you saw sort of a sell-off in banks across their capital structure, both their senior and unsecured, or their senior and their subordinated instruments. And a lot of that was, yes, it was driven by risk aversion, but also to create liquidity in portfolios, as I believe managers were concerned around drawdowns and outflows, etc. And once we saw that initial sell-off in the banking and financial sectors, we then started seeing spreads in some of the other sectors follow suit, and we saw sell-offs really and credit spread widening in the secondary market, really across all the sectors. Now, post that initial lockdown, I think as the economy started to reopen, and I think as investors got a little bit more relaxed around the financial position of the banks and their liquidity, etc., we started seeing sort of cash spreads come back quite a bit, especially on the bank senior unsecured. We saw the interest rate cuts by the Reserve Bank, and all of that really conspired to reduce cash returns quite sharply. And then, as managers were obviously sitting with quite a lot of cash in their portfolios, they were then starting to see, well, how can we deploy this cash in a better and more productive way? And that then started dripping demand back into the credit markets, where we've seen now this credit spread tightening environment, where we're probably back to spread levels we saw pre-COVID, except really for two sectors, being the state-owned companies and the REITs. Now, in a period like this, where you are seeing excess demand and insufficient supply, that's really when credit spreads tighten. And you can see sort of this limited supply. So we've spoken about demand obviously being driven by, I think, continued flows into cash and enhanced cash mandates as investors remain risk averse. But what we've seen is a slowdown in issuance. And that slide at the bottom really shows you how the investable universe has actually declined during COVID. So even if there was no funds flowing in, and investors and managers were really just looking to replace what have matured in their portfolios, there wasn't sufficient supply for that. And really that's led to the supply-demand squeeze. Now as the capital markets opened up, if you look at the top left there, you can see that initially, and this is something we've seen through many cycles in the debt capital markets in South Africa, is that initially there's a preference for private placements by issuers, because they first want to test the appetite in the market. They don't want to risk a failed auction. And as their confidence returns that there will be appetite on a primary auction basis, you'll start seeing those grey bars emerge. And you can see them emerging. And then we had the second wave in December, Jan. And then it sort of started to pick up slightly again. And really the private placement domain is sort of very, there's not a, if you look at the sort of the smaller income managers, they really don't have the scale to participate in the private placement space. So they've been really starved of paper in that primary market. And then, this is, to me, is quite a large driver behind that tightening credit spread environment. And you can see there on the slide how we've shown the grey bars what the allocated bids were in primary auctions. The orange bars are the unallocated portions, and the dots really show the bid to cover ratios, and shows that strong support for primary auctions, how people really are crowding into those auctions and bidding in those auctions to try and secure some credit in an asset light environment, to eliminate some of that cash drag in the portfolio. And then on the bottom there, you can just see the issuance since sort of February 2021, and how we've consistently seen auctions clear at spreads that were either at the bottom end or below price guidance that's set out for that auctions. And it's sort of the manifestation of that strong demand you see we discussed earlier. Now, what are the risks here? So obviously the risk is that you become you adopt a forced buyer approach in this market, and that's never a good position to be in. I think if you start seeing managers adopting that forced buyer approach, you see an acceleration in spread tightening as everyone crowds towards the lower end of guidance or through guidance on primary auctions, and you also see people bidding outsized portions for paper that they're probably just including too much of a single issuer in their portfolios, and that really does create concentration across issuers and industries in portfolios. And for us, that's probably the biggest risk, is that portfolio concentration, because in these enhanced cash portfolios, it's okay to probably have a couple of years where you stomach sort of tighter credit spreads, lower real returns as we are now. But it really is that risk of a credit event and being overexposed to a credit event that impacts your returns for a long period of time, because you've got to claw that back on a continuous basis. So how do we keep ourselves out of that forced buyer mindset? Is that we have multiple sources of origination. So firstly, obviously, you do have the public auctions that we participate in, but we also have sufficient scale to do reverse inquiries for private placements. We get contacted by the DCM teams of all the different banks to make sure that we are front and center, and that they know that we are looking to deploy credit, but we're doing it on a selective basis. And then secondly, to access pools of private debt, either via sort of repack vehicles of the banks, but also through unlisted debt funds that we can access on a pooled basis. So that once you've sorted out that supply side, then it comes down to really the discipline of enforcing your internal limits, making sure that you aren't taking oversized positions just because you see a good piece of paper in the market. Don't go and fill your boots on that. Rather, take a measured approach, wait for the next opportunity, and make sure that that pipeline of opportunities continues to be built out, and that you're not desperate to go and fill your portfolio on that. And that really prevents those big once-off potential losses in the portfolio. So we, as a business, has been very conscious of that. We've actually reduced our counterparty limits during this COVID lockdowns, during the pandemic, to make sure that we maintain that discipline of diversification. And just seeing that in action really is probably it can be best identified through the Ashburton Stable Income Fund. It's an enhanced cash product. It keeps a lot of cash and cash-like instruments to the large banks, but it also, to deliver that enhanced cash return, looks to access the credit markets. So if you look at where the portfolio is positioned, just short of 35% of the portfolio is actually non-bank credit, and of that 34%, 8.9% or just under 9% of the portfolio is in alternative credit, and the other 26% of the portfolio sits in your traditional listed bonds. Now, on the right-hand side, what we've done is we've eliminated those alternate sources of credit and grossed up our listed non-bank credit. And you can see how that actually helps, how alternative sources of credit helps this portfolio. We've increased our number of issuers to over 100. So it's more than double what you can really find in a normal listed credit environment. And what that's done is your average exposure to a credit issuer is actually more than halved, and we're sitting below 0.4% as an average size to a credit exposure. And that really, we believe, is the best way that we can continue to deliver returns, but also avoid those really large once-off events. And I think that just really speaks to discipline and doing what the fund says on the box that it should. So that concludes my presentation on credit and where we are in the markets. I want to thank you for your time, and I'd like to hand over to Dr. James Cook, Head of Global Equities, and Kathy Davey, the Investment Manager, who will explore the benefits of investing offshore through Ashburton International Equity Offerings, and will provide an update on global markets and look at the choices depending on the market environment.